Hey everyone, uh, in this video we're going to be going over tutorial 2 for investments. It's based on chapter 5. So let's get into it. The written section, calculate the EAR of 9.6% APR compounded semi-annually. So you just say 1 plus 9.6%, semi-annual means 2, so that's why you divide it by 2, and because it's semi-annual, you'll square it, minus 1, and you get 9.83%. Then part B says 12% APR compounded monthly, so our return is 12%, and it's compounded monthly, so n is basically equal to 12, so it'll be 1 plus 0.12 over 12 all to the power of 12 minus 1, and we get 12.68%. Then we've got 5.9% APR compounded continuously. So for this we use the E, so it'll be e to the 0.059 minus 1, and we get 6.078%. Then question 2, for the following portfolio, calculate the overall expected return and standard deviation of returns given the range of potential economic scenarios. So we've got our 4 scenarios, we've got a probability for each scenario, and we've got a portfolio return for each scenario. So the expected return will basically just be the probability times the return for each scenario. So you're adding those all up. So it'll be 0.15 times a 21% return plus 0.45 times an 8% return plus 0.35 times a 2% return and plus 0.05 times a negative 7% return, and that will give us an expected return of 7.1%. And then we're also expected to calculate the standard deviation of this portfolio. So you'll just say the square root of everything, and we'll say 0.15 times our return, 21%, minus the expected return of 7.1%, all squared, plus 0.045 times 8%, minus our expected return squared, plus 0.35 times 2% return minus 7.1% expected return, all squared, plus 0.05 minus 7% return times, minus 7.1% squared. So the square root of all of that, and that'll basically give us our standard deviation of 6.9%. Part B, assuming a government bond yield of 6%, calculate the portfolio Sharpe ratio. So the Sharpe ratio is equal to the expected return minus the risk-free rate over the standard deviation. So I'll just plug in those values. 7.1% minus 6% over a 6.9% standard deviation. Plug it in exactly like that, and you'll get 15.79% as your Sharpe ratio. And then if inflation is expected to be around 6.9%, calculate the expected real return of the portfolio. So remember, 1 plus the nominal rate is equal to 1 plus the inflation rate times 1 plus the real rate. And we basically, because we want to find the real rate of return, we just need to change R, make that the subject of formula. So I can move 1 plus I to this side, and I'll basically get R is equal to 1 plus N over 1 plus I minus 1. I can plug in the values of 7.1% and 6.9%, and I'm left with R is equal to 0.187% as the final answer. Question 3. You face the allocation decision of placing your portfolio in a combination of the JSE Top 40, which is expected to return 13.5% at a standard deviation of 16%, and a portfolio of risk-free government bonds, with an expected return of 5.8%. For each of the following allocations, calculate the risk and expected return of the complete portfolio and thus derive the capital allocation line. So 50% in the JSE top 40, 50% in the risk-free portfolio. So the return will just be 0.5 times the return on the JSE, which is 13.5, plus 0.5 times the return on the risk-free, which is 5.8%, and we'll get 9.68% as our expected return. For the standard deviation, it'll just be 0.5 times the risk of the JSE, which is 16%, and plus 0.5 times the risk of the risk-free government bonds, which actually have a risk of 0. So your answer will be 8%. You do the exact same thing for part 2 and for part 3. Let's just do part 3, 130% in the JSE top 40 and negative 30% in the risk-free portfolio. So the return will be 1.3 times 13.5% return from the JSE minus 0.3 times the return of the government bonds of 5.8%. So that basically just means that in this case, we're borrowing. A negative basically means that we're borrowing. So we get a return of 15.81%. Standard deviation, it'll be 1.3 times 16% plus 0.3, sorry, it'll be minus 0.3 times 0%, which is just 0. So we'll get 20.8% risk. Calculate the slope of the capital allocation line. So that's just your Sharpe ratio, expected return minus the risk-free rate all over the standard deviation. So 13.5% minus 5.8% over our 16% risk, and we get 0.48125. Then it says calculate the weightings you would place in each sub-portfolio if you aim to earn an overall expected return of 7.5%. So it'll just be the weight of the risky portfolio times the 13.5% return plus 1 minus the weight in the risky portfolio, because our weights should sum to 1, times our 5.8% return in risk-free return. And that should equal an expected return of 7.5%. I can expand everything out, so I'll get 0.135 times the weight in the risky portfolio plus 0.058 minus 0.058 WR, or weight in the risky portfolio, which should equal 7.5%. I group my like terms and I solve for WR, which is equal to 0.22. So the weight in the risky asset is 0.22. To get the weight of the risk-free asset, I'll say 1 minus the weight in the risky asset, and 1 minus 0.22 is 0.78, which is how much we'll invest in the risk-free asset. Next, we want a return of 18%. So you'll do the exact same thing, except instead of 7.5, now it's 18. So the weight of the risky asset times 13.5% plus 1 minus the weight of the risky asset times 5.8%, which should equal 18%. Expand everything, you should get a weight of the risky asset as 1.5844. So the weight of the risk-free asset is 1 minus that. So we'll get minus 0.5844. So in this particular scenario, we're actually borrowing at the risk-free rate to invest in the risky asset, to invest more in the risky asset. Okay. So what proportion of the portfolio would place in the top 40 fund if your aim is to maintain an overall risk level of 10%? So we'll say 16% times the weight in the risky portfolio times 0 times 1 minus the weight in the risky portfolio, which is equal to 10%. You can basically group your like terms and solve for WR, and you'll get WR is equal to 0.625, and the weight of the risk-free will just be 1 minus the weight of the risky, which is 0.375. Next is the multiple choice section. You put up $50 at the beginning of the year for an investment. The value of the investment grows 4%, and you earn a dividend of $3.5. Your holding period return, it'll basically just be your 4% plus the dividend over the initial amount which you spent. So 3.5 over 50. So you get a holding period return of 11%. So your answer is D. If you want to measure the performance of your investment in a fund, including the timing of your purchases and redemptions, you should calculate the geometric return, arithmetic average return, dollar weighted return, index return. So the answer is C. You have calculated the historical dollar weighted return, annual geometric average return, and arithmetic average return. If you desire to forecast performance for next year, the best forecast will be given by your arithmetic average. The geometric average of -12, 20, and 25. So remember your geometric average return formula. It'll just be 1 plus minus 12% times 1 plus 20% times 1 plus 25%, all to the power of 1 over 3 minus 1. You'll get a geometric average of 9.7%. which is C. The annual percentage rates can be converted to effective annual rates by means of the following formula. I think the only correct formula from this list is A. I'm not sure what the others are, but yeah, just remember all your formulas, guys. Suppose you pay $9,400 for a $10,000 par treasury bill maturing in 6 months. What is the effective annual rate of return for this investment? So it'll just be 10,000 over 9,400, all to the power of 12 over 6 minus 1, and that is your effective annual rate. Your investment has a 40% chance of earning 15% rate of return, 50% chance of earning 10% rate of return, and 10% chance of losing 3%. What is the standard deviation of this investment? So you first calculate your expected return. You'll say 0.4 times 15% plus 0.5 times 10% plus 0.1 times negative 3%. And that's our expected return of 10.7%. I'll use that now to calculate the standard deviation. So I'll take my probability, 0.4 times 15% minus the expected return squared plus 0.5 times a 10% return minus the expected return squared plus another 0.1 or 10% times negative 3% minus your expected return squared. So this will basically give us our variance. I need to square root that, and that'll give us our standard deviation of 5.14%. When calculating the variance of a portfolio's returns Squaring the deviations from the mean results in preventing the sum of the deviations from always equaling 0, exaggerating the effects of large positive and negative deviations, a number in units of percentage of returns. So the correct answer here is B. A portfolio with a 25% standard deviation generated a return of 15% last year when T-bills were paying 4.5%. The portfolio has a Sharpe measure, so just remember your Sharpe ratio formula and plug in the numbers. 15% minus your risk-free 4.5% over the risk, which is 25, and you'll get 0.42. Consider a treasury bill with a rate of return of 5% and the following risky securities. So we've got 4 securities. They've given us returns for each and variance for each. The investor must develop a complete portfolio by combining the risk-free asset with one of the securities mentioned above. The security the investor should consider as part of his complete portfolio to achieve the best capital allocation. So remember your capital allocation line. Basically, the best security to choose would be the one that maximizes your return per unit of risk. So you're going to look for the one with the steepest line or the highest slope in this case. So gradient, the steepest slope. Basically, if you had another line that was below this capital allocation line, that really wouldn't be that efficient because you want to maximize expected return per unit of risk. So the answer, you basically calculate the slope of each security, and the one with the highest one, that's your answer. So in this case, it was security A. To calculate the slope, I just said I took the return of 15% minus the risk-free rate of 5% all over the risk or the variance to the power of a half or the square root, and basically A is the highest. Okay, so number 11, the holding period return on a stock was 25%. Its ending price was $18 and its beginning price was $16. Its cash dividend must have been what? So basically, you'll take your $16 times by 25% because we've got a holding period return there. So $16 times 25% minus the return that we gained through the capital appreciation. So the ending price minus the beginning price, so 18 minus 16, and that'll basically give us the whatever we receive from dividends, which is just $2. An investor invests 70% of her wealth in a risky asset with an expected rate of return of 15% and a variance of 5%, and she puts 30% in a treasury bill that pays 5%. Her portfolio's expected rate of return and standard deviation are what? So expected return, I'll say 0.7 times 15% plus 0.3 times a 5% return. That's how I get 12%, and then I need to calculate the risk of this portfolio. So I'll say 0.7 times the risk of the risky asset, which is 5%, so square root of 5%, and I'll get 15.7%, so the answer is C. 13, you invest 10,000 in a complete portfolio. The complete portfolio is composed of a risky asset with an expected rate of return of 15% and a standard deviation of 21%, and a treasury bill with a rate of return of 5%. How much money should be invested in the risky asset to form a portfolio with an expected return of 11%? So I'll say 15 times x plus 5 times 1 minus x is equal to 11. I'll then solve for x. I'll get 60. X is equal to 16%. Or that's basically the weight that you'll invest in the risky asset. So 60% times 10,000 is $6,000. You invest $1,000 in a complete portfolio. The complete portfolio is composed of a risky asset with an expected rate of return of 16%, standard deviation of 20%, and a T-bill with a rate of return of 6%. Something of your complete portfolio would be invested in the risky portfolio if you want your complete portfolio to have a standard deviation of 9%. So basically the weight in the risky portfolio you should basically do the same thing as we've done before, and you would get a weight in the risky portfolio of 45%. A portfolio that has an expected value of 1 year of 1,100 can be formed if you so I'll say 1,100 is equal to x, which is the weight of the risky portfolio. So I'll say 1,000 times a return of 16% plus 1 minus x times 1,000 times a return of 6%, 1.06. And then I'll basically solve this equation. I'll get x is equal to 40, which is the weight of the the risky asset. So that is our answer A. You have 500,000 available to invest. The risk-free rate as well as your borrowing rate is 8%. The return on the risky portfolio is 16%. You wish to earn a return of 22%. You should, and then they give a whole bunch of options. So we should say y is equal to the 22% return that we hope to receive minus the borrowing rate or the risk-free rate of 8% over the 16% minus again the risk-free rate of 8% or the borrowing rate of 8%, and we get 1.75. So in this case we'll borrow 75%. So it'll be 500,000 times 1.75 minus 1, and we get 375. So we borrow 375,000. You are considering investing 1,000 in a complete portfolio. The complete portfolio is composed of treasury bills that pay 5% and a risky portfolio P constructed with two risky securities X and Y. The optimal weights of X and Y in P are 60% and 40% respectively. X has an expected rate of return of 14%, Y has an expected rate of return of 10%. To form a complete portfolio with an expected rate of return of 8%, you should invest approximately something in the risky portfolio. This means you'll invest something and something of your complete portfolio in securities X and Y respectively. So the expected return is 0.6 times 14% plus 0.4 times 10%, and we'll get an expected return of 12.4%. we're calculating the weight in the risky portfolio. So we're expecting an 8% return, which is equal to the weight of the risky portfolio times 12.4% plus 1 minus the weight in the risky portfolio times your risk-free rate of 5%, and solve for WRP, and you should get approximately 40%. And then we use this to calculate the weight in X and the weight in Y. So WX in the complete portfolio, it'll be 0.4 times 60%, which is 24%, and WY in the complete portfolio is 0.4 times 0.4, which is 16%. So it looks like our answer is C. Um, 18. A security with a normally distributed returns has an annual expected return of 18% and a standard deviation of 23%. The probability of getting a return between negative 28% and 64% in any 1 year is so the answer is actually B. The probability of the returns is basically within plus minus 2 standard deviations. So if you look at your normal distribution, that area with the probability is basically this part here, all of this, which sums up to 95.4%. Okay, a project has a 60% chance of doubling your investment in 1 year, 40% chance of losing half your money. What's the standard deviation of this investment? So the expected return, it'll be 60 times 1 plus 40 times negative 0.5. We'll get 0.4, and we basically use that to calculate the risk. So 0.6 times 1 minus expected return squared plus 0.4 times minus 0.5 minus the expected return squared. So we'll get a standard deviation of 73%. And then you have the following rates of return for a risky portfolio for several recent years. Assume that the stock pays no dividends. What is the geometric average return for the period? So you calculate your returns for the 3 years and you plug that into your geometric return formula and you'll get 2.6%. And then what is the dollar weighted average return over the entire time period? So I'll say 0 is equal to minus 50 times 100 plus minus 55 times 50 over 1 plus the IRR. You basically do that, and you can actually solve this equation in your financial calculator by making use of the cash flow function. So you basically input these figures into your cash flow. So you'll say minus 50 times 100 in cash flow in year 1, minus 55 times 50 in cash flow in period 2, minus 51 times 75 in cash flow in period 3, and then 54 times 75 in period 4. And you basically solve for IRR and you'll get 0.744%. So that's basically the answer. Yeah, and that's tutorial 2.